What's up, everybody? It's Dre Trades here, and today's a unique video. I notice in my videos I'm always talking about, hey, I'm gonna sell this put spread, I'm gonna sell put spreads all day, I'm gonna sell that put, sell this put, I'm gonna sell call spreads here. You know, that's the way I trade. But you know what? You guys might actually have some questions on it. I actually got asked a question. Hey, Dre, how much do you need in your account to sell put spreads? Got me thinking, you know what? If you can find 50-cent wide strikes in certain option chains, you could sell put spreads on the low, on the real low. So that's exactly what we're going to do. I'm going to pull up the IWM, because in the IWM, and I believe sometimes the SPY, but we're going to just play around with the IWM because there's 50-cent wide strikes in there. And we're going to try to sell some cheap put spreads where you don't need a lot of money in your account. Now, there is account type things or reasons you may need more money than what we're doing. First of all, to sell options, you're going to need a margin account, right? And to open up a margin account, generally, I think you need $2,000 in there, right? Or if you were to open up trade options in your IRAs, right? You got to have all the cash in there, cash secured puts. Or, you know, you have to have the cash that you're going to use for the margin. But I still think they want you to have $2,000 in there as well. So you're going to have to find those details out with your broker. All right. But once you straight and your account is set up to sell options, we can sell some cheap options. And I'm going to show you how to do it right here in this video. So if you have any questions, let me know. So let's go ahead and pull up the IWM and see some cheap options that we can sell. All right, let's get to it. All right, so here is the IWM. This is the Russell 2000 ETF, and we're looking at the 4-hour chart. And you see I got this area here highlighted. And the reason why I got it highlighted like that, because I was selling the iron condor up on top and down on the bottom. Basically, I was selling call spreads and also selling put spreads at the same time. So this is the scenario you want to see when you're selling the iron condor. You want it to go sideways, right? You want it to go sideways, right? So I noticed this sideways action. So I was like, you know what? Maybe it will continue to go sideways. So I'll sell some calls and I'll sell some puts. But this video was not about that. This video was about trying to sell some cheap put spreads, and that's what we're gonna do. So let's look at this, and we're gonna say, let's just go to the chain. All right, we know from the most part that we want to sell something maybe below 212 or above 230, but right, we're gonna concentrate on a put, so we'll sell something below 212. So let's go to the option chain, and I notice this is what I've been doing lately, by the way, but we're gonna try to do it on the cheap. All right, so especially on Mondays, I've been, playing with the weekly options, trying to sell out of the money options that expire this Friday, right? And you can see I got a position on right here where I sold the 213s and bought the 208s. I usually do 5 strikes wide. And, that will cost me about $480 or so. I would need $480 worth of margin in my account to pull off such a trade. But can we do this kind of trade even cheaper? Well, if you look at the strikes here, you see these are the strike price, right? These are the strikes where when Friday comes along, the option needs to be below or above this, depending on where you are trading, right? If you're doing put spreads or debit spreads, credit spreads, but we're doing credit spreads. So if we were to trade this 215, we basically need this option chain to expire with the strike, or with the price of the option, with the price of the stock above 215, all right? So 214, 213, 212.5. This is where we could sell cheap options. So you got 212.5. Up here you got 207.5. And even down here, 217.5. So let's sell this 217 because I want to get a lot of credit for this, all right? Because we do have commission charges that we have to pay for, so we don't want the commissions to eat up all our profits. So in this case, let's mess with the 217.5 and buy the 217 for protection. So I'm going to go right click on that. I'm on the Thinkorswim platform and sell vertical, right? So there it is. This is a 50-cent wide option, right? So the most I could lose is $50. All right, $50. Remember, in options, everything is times 100. So 50 point wide, I can lose $50. Now, here's the credit that I can receive. And right now, the mid price is at $13, right? 13, 14, it's going 13. We're going to say we can get it for $13, right? So the most I could lose is $50, but they're going to give me $13 right now. So if I take 15 away from 13, that's $37. So to sum it up, the most margin I would need in my account is $37. I can put this trade on for $37. That's it, period. So let's see what that actually is. Okay, so I know that sounds like chump change. I'm going to collect $37 and risk $37, but that is huge. I would give somebody $37 any day, and you give me back $13, man, I would feel like a loan shark. But let's figure out exactly what that is. So 13 divided by 37 is 35% on our money. That is huge. That is a great trade right there, as long as the stock stays above $217.50. So let's lock that in, and we'll go ahead and analyze this trade and see what it looks like. Let me kind of make sure I got it isolated down here. Get rid of all of this stuff. All right, so here it is. And you can see right here, this is the max gain, right? And you can look over here to the left. You can see how it says $13, right? That's the most we can make at expiration. And the most we can make is the credit that we receive. As soon as we receive that credit, that's the most we can make, right? So at that point, we just got to make sure we don't lose any money. Now, if things go wrong, if the market crashes 20%, and Bitcoin and Doge just take over the world, the most you could lose is $37. And you can see that price over there to the left, right? And that's on expiration day, right? And that max loss happens at $217, right? So if the stock were to be lower than $217, that's it. You're at max loss. You're going to lose $37. So that is a decent trade you can put on. You can put that trade on right now. Now, if you look at the delta, here's the delta of the trade, $2.43. So basically, for every dollar that the IWM moves, for the most part, this option will gain or lose $2.43. Now that will change daily, but that's the way it's set right now. The data you will collect is 0.96. So let's just round that off to a buck, right? So every day you get a buck, right? You get a buck. And then if it would go the next day, see, the next day will be $1.41. Then the next day, $2.07, right? So the theta is actually increasing as the trade comes to the end, right? As we lose days and we running out of trading time, which is this Friday, right? So Wednesday, I don't even know what day I'm in, Thursday, and I think that's Friday. Boom, trades close, and we at max, see, either 37 or 13. All right, so let's bring it down back to today, and there's the trade. All right, so let's look at the delta of the short strike, and that's right here. The short strike is the option that we sold. So we sold the 217.50, and you can see the delta is 29. Now, there's multiple ways you can use the delta, but we're going to use it for the probability of expiring. So basically, there is a 29% chance that we're going to be wrong on this trade. Okay, there's a 29% chance. Look, it's already at 28. That means the opposite is true. So basically, 100 minus 29 is 71, right? So there's a 71% chance that we're going to be correct. So there's a 71% chance that we can keep our $13 and make 35% on our $37 if we put on this trade and the IWM is trading higher than $217.50 by Friday. So you got that? I know that was really confusing, right? So basically, I'll say it again. I'll say it again. I'll say it a little differently. So as long as the IWM is trading above $217.50, we get to keep all of the $13, right? And then, of course, we risk $37 and we would have made 35% on our money. We get to keep, that's like huge. So if you got more money than this, right? And you just like, man, I don't want to do a $37 trade. Well, you could do this a couple of times, right? You could do this maybe 10 times. So now if we analyze that trade, the max loss is $370. And the max gain is $130, excuse me. Now, the percentage will be exactly the same. And how would you figure it out? You just take your max gain, 130, and you divide it into your margin, what you would need for the trade. And that's 370. And it comes out to 35%. Nothing changes there. It's just that the more contracts we put on, the more risk we put on and the more money we can get. But it's the same percentage, right? So this is going to be risking $370. That's all you need to put on a trade to sell 10 of these things. Now, the one thing that we have to keep in mind when we're collecting such little credit like $13 is commissions, all right? So the commissions can eat up some of the percentage. So if I were to calculate the commissions, it might not be 35%, it might be 33%, 32%. But just keep that in mind depending on what your platform is trading at. I know here, I think I pay 65 cents an option. So if I were to do this 10 times, that's $6.50 on one leg and then $6.50 on the other leg, 612, so $13 to put that trade on. Guess what? When it's time for me to get out of the trade, it's another $13. So just keep that in mind that the round trip, if I did this trade, would be $26. All right. So just kind of minus that from what you're going to bring in, and then you can kind of recompute it. All right. I know you want me to do it for you. All right. So let's do that. It's going to cost me $26. So if we look at the screen, it says the most I can make is $130, but that's not true. That's not true because it's 130 minus 26 if we round trip it, right? That's if we don't let these options expire. We're going to assume that we sell in and buy ourselves out, all right? We're going to do both sides. So basically, it's going to cost me $26. So $104 is the most I can make. But guess what, man? I still risking $370. So 104 divided by 370 is $28. So you see how that 35% turned into 28%, right? So, and this is why I kind of don't really trade them that small. I try to trade wider so I can get more credit and less spreads, right? Because I don't want the commissions to eat up my profits. And it's something that you have to decide how you want to trade, because you don't really want to stop a good trade because of the commissions, but you just have to keep it in mind that the commissions will play a factor in your return, right? All right, so that's the trade. Now let's look at this again and let's do something that I would trade. Now I don't trade that way, and hey, there's nothing wrong with that trade. All right, there's nothing. I sure would trade that way. I just don't trade that way. Let me show you the way I trade. All right, so when I'm selling spreads, you have to decide where the stock is not going to go, all right, when you selling options. So that's why I got this drawn, right? And I'm going to say, man, it's going to stay in this range. So therefore, it is not going to go below 211, right? I got 212, right? That's why that box is there. We didn't do the last example that way. So I'm going to go here and I'm going to look below 212. And it says, I immediately look to the right. I'm like, 9 delta? A 9? Okay, so that's basically, I know I'm not going to get a lot of credit, but I have a 91% chance of being right. You know what? So I'll take it. I'll sell the 212 and I'm going to sell a vertical, but I'd like to do mine's 5 wide. So I'm going to buy the 207 and I immediately just jump it down to 5, and there it is, 20 cents. I'm going to collect 20 cents for that $5 wide spread, right? So basically $5 wide, I'm risking $500, but they're going to give me $20 right now. Okay, so I'm really risking $480, right? So $20 divided into $480 is 4%. That's not much money, but imagine if you collected 4% every week on your money. 4%? So 4%, and it's like 52 weeks, right? Man, Did I do that right? That number's so big, I don't even know if I did that right. It would be 208% on your money. 200. So basically, if you did this every week and collected that 4%, basically sold that 9 delta and never had a losing trade and let it expire every single time, and you started with $1,000, you would have made $2,000, right? $2,000 on that $1,000 for a total in your pocket, $3,000. So you have to keep the big picture in mind when you sell these things. Just keep the big picture in your mind and stay consistent, right? Stay consistent. Now, I don't do it every single week, but I try to do it most weeks. So let's get back to the chain and analyze my trade. All right, so here we are in the Analyze tab, and here's the trade down here. I sold the 212, bought the 207 for 19 cents. I think it must have changed on me. Didn't we do 20 cents? I think 20 cents. Anyway, so you can see the most I can make is $20, right? And man, look, the stock is already at 221. I mean, I'm way down here, right? And the most I can lose is 480. Now, that's a lot of money I'm risking just for 20 bucks, but there's a damn good chance that I'm going to be right, and that chance is about 91%. 91%. All right, so just kind of keep that in mind, and you keep doing that. Do it next week. Do it 5 weeks in a row. You bam, you done made $100. You know what I'm saying? So that's the trades I put on. I might do it 5 times, right? Depending, and that's 2,400 to collect 100. I might do it 10 times. Usually I don't go higher than 10, and that's $4,800 to collect $200, right? And have a $200 payday on Friday. Hey man, I'll take it. So that's it, man. That's the trade. It's really that simple. I know I still think I kind of went kind of fast. I don't know if I explained it well, so I'm gonna need you to put any questions in the comments below, and then I can answer them. Let me know if you like this video. Let me know if I helped you understand. I'm not the greatest teacher. Because it's like, even though this is a pre-recorded video, like I record it, then upload it, then you watch it, it's kind of like I'm doing it live. You know what I mean? I have no script. I'm just going right off the top of the dome. So hopefully I explained it correctly and you understand. Like I said, so I like to do 5 wide strikes. I like to sell 5 wide strikes, usually around the 10 delta, the 9 delta, maybe as high as the 12 delta. But if you find those 50-cent strikes, and I always find them in the IWM, and I believe sometimes they're in the SPY, and maybe in the QQQ. In the shorter term options, I always notice. Just look for them, you might see it, and then you go, boom, oh man, I can risk $30 for the most part and make a pretty decent return on your money. You just most likely, you have to step up the contract if you want to risk more. All right, so there it is. Thanks for watching. I'm Dre Trades. I'm on Instagram, I'm on Twitter. And like I said, I really hope you like this video. Subscribe, hit the bell, all that stuff the YouTubers say. Thanks for watching. I'll see you.